Hi everyone, I'm Ara Ogorian with ACap Advisors and Accountants, and welcome to another edition of the ACap Recap, where we go behind the blog and answer some of your most important questions. And today we're going to talk about the wash sale rules. But before we begin, remember to subscribe, like, and share our channel. And if there's a topic that you want us to cover, be sure to send us a message or include it in the comments below, and we'll talk about it in a future episode. One of the most common tax saving strategies is tax loss harvesting. Tax loss harvesting is intentionally selling an asset at a loss and then deducting that loss on your tax returns. However, a lot of people get ensnared in the wash sale rule. Today, we're going to talk about what is the wash sale rule and how you can avoid it. Simply put, a wash sale rule is not being able to deduct a realized loss on an investment on your tax return. Obviously, no one likes to lose money on an investment, but there are times when you buy an investment and it goes down in value. So as I mentioned earlier, one of the common strategies for tax savings is tax loss harvesting, intentionally selling that investment and then taking that loss on your tax return. So let's use an example. Let's assume you bought a stock for $100 a share, and now the price has gone down and it's worth $80 a share. Well, if you don't sell that stock, you have what's called an unrealized loss. You haven't realized it because you haven't sold it. But if you sell that stock and now you have a $20 loss on that stock, you can deduct that on your taxes. However, you cannot buy that stock back again within 30 days, because if you do, then you are subject to the wash sale rule. So you have to wait at least 31 days before you can buy that stock back again, so that you're not subject to the wash sale rule and you're able to deduct that $20 loss on that sale. The wash sale rule goes further by saying you cannot purchase the stock 30 days beforehand before your sell either. Also, you cannot trade substantially identical stock that's similar to the stock that you sold. Also, you can't trade in an options contract or any other contract that's substantially similar to the investment that you sold. And also, it cannot be in any type of retirement account. So you can't sell the stock at a loss in your brokerage account and then repurchase the same stock or identically similar stock in your IRA or your traditional or your Roth IRA or a retirement account. There are two ways you can tell whether or not you've been subject to the wash sale rule. The first method is to log into your brokerage account, whichever brokerage account you use, and look at the realized gain or loss. And on the realized section, you may see a little W that depicts a wash sale, that you've been subject to the wash sale. The second way you can tell is when you get your 1099 at the end of the year, usually late January, early February, that shows all the transactions for the prior year. You'll also see a little W next to any losses that you have. If you do see that, that means you've been subject to the wash sale rule for that one particular transaction. As a CPA, one of the most common things I see on day traders' 1099 tax forms is that they've been subject to the wash sale rule. So a lot of times people have a lot of losses throughout the year, and then they think they can claim it, but then they realize, or I realize I have to tell them the bad news, that they cannot deduct those losses because they've been subject to the wash sale rule. So the best way to avoid the wash sale rule is if you're going to sell an investment at a loss and you want to take that loss on your taxes, wait at least 31 days before you buy that investment again. And make sure you have not bought that investment at least 30 days prior to you selling it as well.